And now you must choose debit or credit.
But I am new to this. I don't know how to choose.
Use the accounting equation, Neo.
The accounting equation? What is that?
The accounting equation is everywhere. It's all around us, even now in this very room. You can see it when you look out your window or when you turn on your television. You can feel it when you go to work, when you go to church, when you pay your taxes. It is the world that's been pulled over your eyes to blind you from the truth.
What truth?
That you're a slave, Neo, like everyone else. You were born into bondage, into a prison you cannot taste or see or touch. A prison for your mind. Unfortunately, no one can be told what the accounting equation is. You have to experience it for yourself. This is your last chance. After this, there is no turning back. You choose debit, the story ends. You wake up in your bed and you believe whatever you want to believe. You take credit, you stay in Wonderland, and I show you how deep the rabbit hole goes. So, there are shortcuts to record debits and credits. Some of these shortcuts are like the acronym dealer and AC Adler and some other ones that exist on the internet. And these are fine. I've explained them in prior videos, and it's okay for you to use an acronym at the beginning of your career, say year 1, 2, 3, 4, even 5. It's okay. Once you get beyond year 5 as an accountant, you need to understand how to record debits and credits on a more fundamental level and more than just remembering an acronym like dealer or AC Adler, right? Which is what we're talking about today. The only shortcut you'll ever need for journal entries. Before we get into that, I want to clear up one misconception about debits and credits. So a lot of you have told me in the past that they thought that debit means increasing something and credit means decreasing something. Always, right? That's not the case. That's not true. Debit doesn't mean to increase something and credit doesn't mean to decrease it. This is just a way for us to organize the business transactions. So it's a language, and a language of business that we came up with as an accountants over the last century. So over the 20th century, we came up with a way so that we can record the transactions as journal entries in terms of debits and credits. And we'll go through some examples here in a second. We can take these transactions and summarize them in a trial balance. So for the trial balance to work out, we need to have debits and credits that balance out. Let me give you a quick look on a trial balance to show you what I mean. Here is what the trial balance looks like. And again, it's a listing of all of the accounts that we use in the business, the debit balance in these accounts and the credit balance. And the objective is that we look and see that our total debit balance ties to our total credit balance, giving us an indication at least that we have a balanced set of transactions. Okay, so if we're saying that debit doesn't always mean increasing something and credit doesn't always mean decreasing something, what does it really mean? Okay, so to understand what it really means, we have to go through what we call the accounting equation. So let's write out the accounting equation and go through what we mean by debit and credit as a language of business. Okay, so the accounting equation says that assets are equal to liabilities plus owner's equity. And the reason why this makes sense, these two sides are equal, is because everything we have in the business is financed either through a liability or an equity that you raise, right? So whatever you have in assets, think of all the things that you have in assets. You have cash, you have inventory, you have accounts receivable, you have land, you have multiple things, right, as assets. All of these things have been financed either through a liability or an equity. So your initial cash in the business most likely came from an equity that someone raised an investment in this company to raise that initial cash. Your inventory. When you get inventory, you can finance that through a liability. So think when you buy inventory, debit, inventory, credit, accounts payable. So you're getting that through a liability, right? Accounts receivable, same thing. To sell your inventory and create accounts receivable, you are doing that through most likely some kind of liability, either the accounts payable or a loan from the bank or an equity from the owners, one of these things. So the reason why this balances out is that everything in assets is financed through one of these two methods here, liabilities or equity, right? So what we're saying is that everything that we own in the business equals to the stuff that we owe, right? So everything that we own the assets, is going to be always equal to the stuff that we owe, right? We owe liabilities to third parties, and we owe owners' equity to whom? To the owners, of course. Okay, so this is what the accounting equation means. Now, let's use that to come up with our debits and credits. To organize our business transactions, we usually record them in the form of an account. So we have the concept of an account. So what are the typical accounts that we have? Well, we have assets, such as cash, accounts receivable, inventory, etc. Right? There are many types of accounts under assets. We have liabilities, and this could be things like accounts payable. We have long-term loans, and it could be other things like deferred revenue and other things like that, but these are the main ones. We have equity, and under it we have owners' equity, and we could have other common stock at par value and other accounts, but this is the main one that you see under equity, plus of course retained earnings. Okay, besides assets, liabilities, and equities, we'll always have other transactions to run the business, and these are going to be things like revenue. We're going to have expenses, and we're going to have dividends when we pay out dividends to the shareholders. Okay, so now how do we use the accounting equation to be able to decide what to debit and what to credit in every business transaction? Now, the accounting equation says assets equals liabilities plus owner's equity, and that tells us that assets, which is always a debit, is going to be always equal to the credit. This is the fundamental thing here, is that assets have a debit nature, liabilities and equities have a credit nature. What it means to have a nature is that assets have a debit nature, that to increase them, you got to debit them, right? Same thing here, liabilities and equity. To increase them, what do you got to do to them? You got to credit them. Okay, so however, when we look at this accounting equation, we're missing some of the other accounts. We're missing revenues, expenses, and dividends, right? So how do we decide what to debit and what to credit when it comes to revenue, expense, and dividend from the accounting equation? Well, the answer is going to be always to look at the effect on equity, right? So what does revenue do to your owner's equity? As you get revenue, right? You increase owner's equity, right? So that means revenue and owner's equity move in the same direction. So therefore, revenue is going to always be in the credit side. Meaning to increase revenue, you got to credit revenue. Expenses. So this one, I'll let you guess, right? When you have an expense, what does the expense do to equity? You always measure on equity. Equity is your North Star when it comes to that. What does expense do to owner's equity? Well, expense is going to reduce owner's equity, right? So it's going to have an opposite nature to its credit nature, meaning expenses are going to fall on this side. Dividends. You can guess that one too. So dividend. What does dividend do to owner's equity? Well, dividends, when you take out dividend from the business, is going to reduce owner's equity. So it has an opposite nature to its credit nature. That means dividends are going to be on the debit side, meaning that they have always a debit nature. To increase dividends, you got to debit them. All right, so let's go through some examples so that we can practice what we learned so far. All right, and remember, we said assets always have a debit nature, and liabilities and equity have a credit nature. That's going to help us when we go through these business transactions. So transaction number one, the company raised $1 million from investors and $500,000 from a loan, from a business loan. Okay, so we have $1 million that came in from investors and 500K from a loan. Let's deal with the $1 million from investors. So you're receiving $1 million, right? So let's begin by choosing which accounts to choose. So you're receiving $1 million coming in. That's cash, all right? Cash is a type of an account that sits under assets, right? So we'll create a T account for cash. Of course, in real life, we're not using a T account. When we record journal entries, this is only for us here to learn. But in the real world, it's going to be recorded in an ERP software, right? And if you want to learn more about that, how it's done in the real world, you're going to want to check out the Controller Academy, where I walk you through all of that stuff in a real company setting so you learn exactly how corporate accounting works. Okay, so for cash, we're receiving $1 million. Is that going to be a debit or a credit? Well, we said to increase in assets, it's a debit, right? So we're going to record $1 million as a debit. Debit always goes on the left of the T account and the credit goes on the right of it. Okay, so for every journal entry, there are two sides. We said the debit is going to be to cash. What is going to be the credit? Well, the credit could be a number of things when you have cash coming in, right? The credit could be maybe revenue. Maybe you sold some stuff. In that case, we will credit revenue. But we're not selling anything here. We're just receiving initial investment from investors. So what is the credit going to be? A liability? Yeah, well, we owe the money to investors, but it's not a liability. It's more of an owner's equity. Okay, so your other side is going to be an equity. That's the other T account. And you're going to record $1 million. Is it going to be also a debit? No. Well, you want to record a credit that's going to balance out your debit. And the reason why it's a credit is because we said equity has a credit nature, always, right? So that balances out $1 million. Okay, great. We said we raised $1 million from investors and 500K as a business loan from a bank. Okay, so what is the 500K going to do to my cash? It's going to increase it. And we said to increase cash, it's always going to be a debit. So we're going to record 500K here in cash. And then to balance out that entry, the credit side of it, is it an equity? Well, no, this is a liability, right? So right here. So we're going to create a T account for that and call it long-term loan. And your credit is going to be to long-term loan for 500K. So that balances out. We have a debit and credit. Okay, let's go through another transaction here. Transaction number 2 is that we paid the first month in rent, $30,000. Okay, so we paid $30,000 for the first month in rent. All right, so we'll create a T account for the first account and a T account for our second account, right? We know that we paid $30,000. That means one of the sides is going to be cash. So cash is going to be one side of that entry. And the other side of it is rent. We paid rent. That's the nature of what we're doing here. Rent is an expense. Okay, so we'll have rent expense on the other T account. All right, so in terms of debits and credits, we spent $30,000. So cash is going to be a credit because we're reducing cash. Remember, it has a debit nature. To reduce it is the opposite. So $30,000. That's going to be a credit. Expense, what nature does it have, an expense, right? In terms of debit and credit. Well, it goes against equity, right? Because expenses reduce your equity in a company. So it has the opposite of what equity is. The equity is always a credit. This one now is going to be a debit because it has an opposite nature. 30K on debit, right? And that's going to balance out our entry, right? By the way, that same journal entry can be written in a different format. Some would write it like this. Write debit, rent expense for $30,000 and credit cash for $30,000, right? Either way, this is just a way to illustrate how we record the journal entry. In real life, again, this is going to be recorded in ERP or an accounting software, not on a whiteboard like this. Let's go through our third example. Our third example is that we bought $200,000 worth of finished good inventory, 200K worth of finished good inventory. Okay, so I have two T accounts, one for inventory and one for cash because we are spending on cash. It's possible that we're also getting it on credit, so it's accounts payable. So actually, to make this one more interesting, let me do accounts payable, right? Because accounts payable is a liability that you incur initially before you pay it out in cash, right? So we bought 200K worth of inventory on credit. So 200K inventory, is that a debit or credit? Well, it's an asset, it has a debit nature. It's going to be always a debit, right? And for the other side is accounts payable. Accounts payable is a type of liability, right? So that always has a credit nature. Okay, that balances it out. Okay, for our final transaction, now that we have 200K worth of inventory, we will go ahead and sell it. So we'll sell that same inventory that we bought for 200K, we'll sell it for 300K. So we're making a profit here of $100,000, which is pretty sweet. All right, so we're selling it for 300K. Let's create the T accounts necessary for this transaction, which is transaction number 4, selling all of this inventory for 300K. So the first T account is going to be inventory, right? Because our inventory is going to be reduced now that we're selling it, right? So inventory is going to be reduced by the amount that we sold it for. How much inventory is reduced? Well, the value that you bought it at, 200K. So you're going to reduce it by 200K, right? What is the other side of that journal entry for 200K? Well, to come up with that, you got to think through it. So thinking through it, when I reduce my inventory and I make revenue now, right, I must have some kind of cost that would go on my income statement. So the cost of the inventory, we call it cost of goods sold. And it's a type of expense, right? So we need to create a T account for that, and we call it COGS, or cost of goods sold, right? And we will record the flip side of the 200K as a debit. Why? Well, it's an expense. An expense always have an opposite nature to equity. Equity is a credit. My expense is going to always be a debit. Okay, so that's the first part of my what I'm doing here is that I'm selling the 200K worth of inventory. I'm selling it for 300K. But I have to record now the 300K. I'm receiving revenue for 300K. And that's going to impact a couple of different accounts. It's going to impact revenue, right? And it's going to impact my accounts receivable, right? Because I'm selling on credit. So I sold 300K worth of inventory. Inventory originally cost me 200K, so I'm gonna reduce it from my inventory. Now my inventory balance is 0, right? Because it came in and it went out, right? And I have a cost of 200K that will go on my income statement. Now, for my revenue is gonna always have a nature that corresponds with equity because revenue and equity move in the same direction. Revenue is nice to equity, is favorable to equity, right? So then revenue is going to be a credit. So 300K in revenue and debit to accounts receivable, which is always an asset, is always a debit, right? And that completes that transaction. And this transaction number 4 was slightly more complex because it has 2 journal entries, not 1. The first journal entry is to reduce my inventory, right? And record the corresponding cost that would go on my income statement. And it has a second journal entry that is to record the revenue and the accounts receivable. Okay, I hope this makes a lot of sense and that you will begin to use this instead of dealer or DC Adler as you get through in your career. It's fine at the beginning, but as you get more experienced, you need to be using this. If you like the video, hit the like button and share it with someone who will benefit from it. Thank you.